Picture this. You are sitting at your kitchen table, going through some old paperwork. Maybe you are clearing out a filing cabinet, or perhaps a family member recently passed away, and you are helping settle the estate. You come across the closing documents from a home sale, and then a thought creeps in: did we file the right form with the CRA? If that question just gave you even a small feeling of unease, this video is for you. And if you have never heard of that form, you absolutely need to stay right here. Hi, I am Joseph, and welcome back to Canada Pension Guide. Every week on this channel, we break down the rules, the risks, and the rights that every Canadian senior and retiree needs to know in plain language, no jargon, no confusion. Today we are talking about one of the most common and most costly mistakes that Canadian homeowners make every single year. And in 2026, the Canada Revenue Agency has made it very clear. They are watching, and the consequences are real. I need to tell you something important right now, before we go any further. If you or anyone in your family sold a home, a cottage, a rental property, or any piece of real estate and did not file one specific form with the CRA in the year of that sale, the penalty alone could be up to $8,000. $8,000. And that is just the fine for missing a piece of paper. But here is the part that catches people completely off guard. If that form was never filed, the CRA does not just send you a bill. They can strip away the entire tax-free status of that home sale. We are talking about a house that may have gained $300,000, $400,000, even $500,000 in value over the years, and now all of that appreciation could be treated as taxable income. And there is no time limit. That is right. The CRA can reach back and reassess that sale years later, even a decade from now, protect you. The next few minutes could save your family from a financial shock you never saw coming. Stay with me. 5. Property traps the CRA is watching in 2026. Let us walk through the 5 specific situations the CRA is actively flagging right now. I want you to listen carefully, because any one of these could apply to you or someone you love. Number 1. The form you did not know existed. For decades in Canada, if you sold your primary home and it qualified for what is called the Principal Residence Exemption, you did not have to do much of anything. That exemption meant your home sale was tax-free. Many Canadians, especially those who have owned their homes for 20 or 30 years, still believe that is how the system works. It is not. Not anymore. Since 2016, and this is enforced in full force right now in 2026, you are required to file Form T2091. It is called the designation of a property as a principal residence. This form must be included with your tax return in the same year you sell the property. Here is what makes this so dangerous. Even if your home sale would be completely tax-free, even if you do not owe a single dollar to the CRA, you still must file that form. Failing to file it can cost you up to $8,000 in late penalties. And more seriously, it opens the door for the CRA to disallow your entire exemption. The fix: if you sold a home any year since 2016 and never filed Form T2091, speak with a tax professional about filing it late. The CRA does have procedures for late designation, but the longer you wait, the more complicated and expensive it becomes. Number 2. The 365-day rule that changes everything. Starting January 1, 2023, the federal government introduced something called the Residential Property Flipping Rule, and it is exactly as strict as it sounds. Here is the rule in plain language. If you buy a home and then sell it within 365 consecutive days, less than 1 full year, the CRA automatically treats the entire profit as business income, not a capital gain. Business income. Why does that matter? Because as a capital gain, only half of the profit is included in your taxable income. As business income, 100% of the profit is taxed. And perhaps most importantly, you lose the right to claim the Principal Residence Exemption entirely, even if that home was genuinely where you lived. 364 days. You miss the threshold by 1 day, and the tax treatment changes dramatically. The fix: If you are planning to sell a property you recently purchased, mark your calendar carefully. Know your acquisition date. If you are even close to that 1-year line, speak to a tax advisor before you list. Before we continue, I want to hear from you. Drop your province in the comments right now and tell me, did you know about Form T2091 before watching this video? Just type your province and the word truth if this is new information. You may be surprised how many people are in the exact same position. Number 3. Short-term rentals are no longer a gray area. If you have been renting out a room, a basement suite, or a property on platforms like Airbnb or VRBO, listen carefully. Effective with the 2024 tax year, the CRA now denies all expense deductions related to short-term rentals if the property does not comply with local municipal licensing and zoning rules. That means, if your city or town requires a permit to run a short-term rental and you do not have one, you cannot deduct a single dollar of operating expenses, not utilities, not insurance, not repairs, nothing. Many seniors who have been supplementing their income this way are now facing a significant tax increase without realizing the rule changed. The fix: check your local municipal requirements for short-term rentals. Obtain any required permits, and make sure your rental income has been properly reported on your tax return each year. Number 4. The cottage and second property problem. This one is very specific to seniors, and it surprises people every single time. In Canada, only one property per family unit can be designated as a principal residence for any given year. If you own both a home and a cottage, or any 2 properties, and you sell one of them, you must make a deliberate, strategic choice about which property receives the principal residence designation for which years. This is not automatic. It requires careful calculation to determine how to allocate the years between properties to maximize your tax-free benefit. Many families lose thousands of dollars because they simply assumed the cottage sale would be covered, and it was not. When a spouse passes away and the surviving partner later sells either the home or the cottage, this issue becomes even more critical. The estate and family may be eligible for certain designations, but only if the paperwork was handled correctly. The fix: if you own more than one property, sit down with a tax professional specifically to review your principal residence strategy before selling either property. Number 5. The CRA is using technology to find you. I want to be very direct with you here. The CRA is not waiting for Canadians to come forward and self-report. They are actively using advanced data systems and artificial intelligence to identify unreported property transactions. They have access to real estate transaction records. They cross-reference land registry data. They are pulling information from financial institutions. And they are comparing all of that data against what was filed on your tax return. If there is a property sale on record that does not appear on your tax return, the CRA system will flag it. You may receive a letter, you may receive a phone call, or you may simply receive a reassessment notice sometimes years after the fact, with interest and penalties already calculated. The best time to address a missed filing is always before the CRA contacts you. Your step-by-step protection plan. Now I want to shift from the risks to the solution, because everything I just told you is fixable if you take action. Here is your protection plan, step by step. Step 1. Think back to every property you have sold since 2016. That includes your primary home, a cottage, a rental unit, an inherited property, any real estate. For each one, ask yourself or your accountant, was Form T2091 filed in the year of that sale? Step 2. If you are not sure, contact a qualified tax professional, ideally a CPA or tax lawyer with real estate experience. They can review your past returns and determine whether a late filing needs to be made. Step 3. If you are planning to sell a property in 2025 or 2026, do not wait until tax season. Talk to your accountant before you accept an offer. Know your adjusted cost base, know your ownership timeline, and confirm your designation strategy in advance. Step 4. If you own a short-term rental, verify your municipal licensing compliance right now, not when you file. The CRA considers non-compliance retroactively. Step 5. If you are the executor of an estate or helping a family member manage a deceased parent's affairs, remember that Form T2091 is the version of this form used when a homeowner has passed away. This is one of the most commonly missed filings in Canadian estate administration. A single conversation with a tax professional now could save your family tens of thousands of dollars later. This is one area where DIY tax filing genuinely carries serious risk. If this video helped you understand something you did not know before, please take a moment to share it with a friend, a sibling, or a parent who may be in this situation. The information in this video is not complicated once someone explains it clearly, but most people simply never hear it until it is too late. Right here on Canada Pension Guide, we are committed to making sure that does not happen to you. Every week, we cover the programs, the rules, the deadlines, and the changes that affect Canadian seniors and retirees in plain language, backed by official sources, with no agenda other than helping you protect what you have worked a lifetime to build. If you are not yet subscribed, please do that now. Hit the notification bell so you never miss an update. And if you have a question about your specific situation, drop it in the comments below. I read them, and your question may become the topic of our next video. Until next time, stay informed, stay protected, and take care of yourself and the people you love.